The tax code now gives you a window to reposition income, grow wealth more efficiently, and build retirement income streams that can be 100% tax-free. The key to tax-free retirement income isn't a secret account or a loophole. It's about understanding the tax rules and using them while they're in your favor. How long the tax code stays like this is anyone's guess. Let's make sure that we're taking advantage of this situation right now. This new tax landscape is incredibly valuable for retirement planning. If you listen to congressional talking points, they say that this tax bill has huge tax breaks for billionaires and nothing for the little guy.
The tax cuts for billionaires were made permanent in the so-called Big Beautiful Bill.
They're cutting taxes for billionaires.
$1 trillion in tax breaks to the top 1%.
Are doing everything they can to give tax breaks for their billionaire buddies on your back.
Well, in my opinion, that couldn't be farther from the truth. There are so many new advantages for us non-billionaires. Many people don't realize that today's tax rates are historically low. The top federal income tax rate under the new law is 37%, but most Americans fall into much lower tax brackets, 10%, 12%, 22%, and 24%. Check out this chart from the Tax Foundation. It shows the top marginal tax rate going all the way back to 1913. The top rates were over 80% and most were over 90%. I'm sure that you're saying, well, Colin, but I'm not in the highest tax bracket. Well, the truth is that the other brackets were much higher as well, and much lower incomes pushed you up into those brackets. Right now, we have the lowest aggregate tax rates since 1992. We're living in a very friendly environment for proactive tax planning. And here's where it gets even better. Under the Big Beautiful Bill, the standard deduction saw a major bump. In 2026, the new increased standard deductions for single or married filing separately are $16,100, and for married filing jointly, $32,200, and for head of household, $24,150. And there's an extra standard deduction if you're age 65 or older. In 2026, if you're age 65 or older and single or head of household, you get an extra $2,050 deduction. If you're married and each of you are over 65, you get an extra $1,650 deduction per person, or $3,300 total. In addition, if you've reached age 65 and older, there's now a new super senior bonus deduction. It's a temporary $6,000 bonus deduction per eligible person, whether you itemize or you take the standard deduction, if your adjusted gross income is below $75,000 if you're single and $150,000 for couples, phasing out over those levels. And it's available from 2025 to 2028 and is added to the other deductions. That means that a married couple, both over 65, could have a standard deduction of $47,500 before paying a penny of federal income tax. Think about that for a second. The first $47,500 of your income is taxed at zero if you are below those thresholds. That's powerful, especially when you're building strategies to keep your taxable income low and your effective tax rate close to zero. All right, let's pause for a moment and make sure that we're clear on one key concept that trips up many people: the difference between income and taxable income. Your income is what you earn from all sources: your business income, a job, dividends, pension, Social Security, capital gains, and interest. Your taxable income is what's left after deductions. It's the number the IRS actually taxes you on. And thanks to these new larger deductions, your taxable income can be much lower than your gross income, which means more flexibility in managing tax brackets, Roth conversions, and qualified retirement withdrawals. Now let's look at where the sweet spots exist in the 2026 brackets. This is what creates the real tax planning opportunities. For decades, we had higher marginal tax rates, and you moved into these higher rates at much lower income levels. That all changed with the 2017 Tax Cuts and Jobs Act and was made permanent this past summer in 2025 with the Big Beautiful Bill. For middle-class America, rather than being penalized the more income you earn with higher rates, we now have some pretty favorable tax rates, and it takes a big income jump to move up into a higher bracket, keeping the vast majority of Americans with some pretty low tax rates for the time being. Take a look at these charts. These are the tax rates for single individuals on the left and for married couples on the right. For singles, the first $12,400 after the standard deduction is taxed at only 10%. Then up to $50,400 is taxed at only 12%. Then there's a big jump up to 22% from $50,401 to $105,700, and 24% from $105,701 to $201,775. And once you go over $201,776, you're taxed at a much higher 32% rate and even higher rates above that. For married couples, the first $24,800 after the standard deduction is taxed at only 10%. Then from $24,801 to $100,800 is only taxed at 12%. Then you jump up to a 22% tax rate from $100,601 to $111,400, and 24% from $211,400 all the way up to $403,550. It's at $403,550 where tax rates increase to 32% and upwards from there. Now, let's step back in time to 2017. At that time, for married couples, you were taxed at 10% on only the first $18,650. But you were taxed at 15% up to $75,900, and then 25% from $75,900 to $153,100, then 28% from $153,100 to $233,350, and then 33% and on up once you cross $233,350. Tax rates less than a decade ago were substantially higher, and you got into those brackets much, much faster, and the deductions were much less. For example, let's say a married couple back in 2017, after deductions, had $250,000 of taxable income. Your federal tax was $52,222.50 plus 33% on the amount that was over $233,350 of income, which was $5,494.50 for a total federal tax bill of $57,717. Let's compare that to 2026. After the much larger tax deductions we receive today, let's say that you still had $250,000 of taxable income. Well, your federal tax is $45,186 versus $57,717 for the exact same income back in 2017. You are saving $12,531 in federal taxes as a married couple, not including the over $30,000 standard deduction where you aren't taxed on any of that income. For all of the people shouting at the mountaintops that tax breaks go to only billionaires, it just isn't true. I've just shown you how there is a large tax cut for many hardworking people in America that surely aren't billionaires. So other than the tax savings that you can reinvest into your investment portfolio, what's the real advantage of this in the tax code? Well, it's what I call the sweet spot in the tax code. Let's pull up those 2026 tax charts again. The sweet spot in the code for financial planning is just before your taxable income pulls you up into that higher tax bracket. And more specifically, let's look at two brackets. If you're single, you can see that when you cross roughly $50,000 of taxable income, that's when your rate jumps from 12% up to 22%. And when you go over $201,000 of income, your tax rate jumps up to 32%. The income between $12,401 and $50,400 and the bracket from $105,701 to $201,775 are the sweet spots to take advantage of. You want to do whatever you can to keep yourself in those two brackets. So if your income is going to go slightly over into one of those higher brackets, finding deductions to keep yourself under them is smart. And if you're solidly into those brackets, exploring strategies like Roth conversions to maximize that low tax bracket makes a heck of a lot of sense. Let's look at married couples now. You can see that when you cross roughly $100,000 of taxable income, your rate jumps from 12% up to 22%. And then when you go over $400,000 of income, your tax rate jumps to 32%. The income between $24,801 and $100,000 and the bracket from $211,401 to $403,550 are the sweet spots to take advantage of. Again, if your income is going to put you slightly over and into one of the higher brackets, finding deductions to keep yourself in those lower brackets is smart. And if you're solidly into them, exploring Roth conversions to maximize that low bracket makes a heck of a lot of sense too. But wait, there's more. I can't tell you the number of new retired clients who come to me and show me their tax return. They say, look at this tax return, I paid no tax last year. And when I look at that, yes, they didn't pay any tax. And in fact, with their deductions, they actually didn't even use them all. They could have converted an IRA to a Roth IRA at a 0% tax rate. That is a huge missed opportunity. Or they had large unrealized gains in a non-retirement account in a few stocks. Well, they could have strategically taken those gains at 0% capital gains tax rates had they planned properly. Or what if you're temporarily unemployed and your income is artificially low for a year? Or you sold a business and are figuring out what to do for a year? Well, maybe it makes sense to look into a Roth conversion or generate a capital gain if you have ample savings to pay the tax while you're in those artificially low brackets. Roth conversions could be ideal in these situations, but it's important to discuss your options with your tax and financial advisors before making any planning decisions. Look, that's the blueprint for creating future tax-free income. Use today's favorable brackets and generous deductions to reposition income now before Congress inevitably tweaks things again, most likely by raising rates. And that's why this all matters. Look, we know the federal government is running record deficits, and the national debt has crossed $36 trillion. At some point, the math just doesn't work. And when Washington needs money, tax-deferred accounts like IRAs and 401ks look like easy targets. You don't need to look any further than the state of Maryland and the city of New York. In Maryland, the current governor was looking to raise additional revenue to pay for things. So he created new income tax brackets and an additional capital gains tax. In New York City, newly elected mayor Zohran Mamdani has already stated that he wants to raise already high taxes on New Yorkers. It's my bet that future tax rates will be higher, not lower, all over this country. And that's why I believe that today's lower tax environment is a gift. One that won't last forever. So you use it or lose it. If you take one thing away from this video, let it be this. This new federal tax law gives you a unique window to build tax-free income for your future. If you're looking for ways to build a 100% tax-free retirement income, check out the other videos in this series. They're coming up soon. And if you own a business and are interested in optimizing your financial planning, you can get started working with me today by visiting celestialwm.com and clicking the Start Here tab to schedule an initial call. Still not sure that you want to talk? Well, head over to my resource center and learn more about my financial planning process by watching my 35-minute complimentary training. And check out this video next for even more ways to supercharge your net worth.